if that in fact does. Hello, we got a caller from Miami. Dan, are you there?
Yeah, I am, Larry.
How are you? What can I do for you, my friend?
I got a nagging question about the gold futures contracts. The current month obviously is M, and it's rolling a couple days to the next contract.
Yes.
The contract I'm trading is like the E-mini, is the E-micro. It's like $1 for $10.
Sure.
Anyway, my question is, I can't seem to figure it out myself. The present M contract is the same price as the gold contract, and the next contract is like $7 or $6 higher. What happens if I was to get long the August contract? That would be the Q contract.
Mm-hmm.
That roll, would that $7 difference or so, would that revert back to the gold contract? This is something I can't figure out.
No. Basically, what you're doing is, because it's trading at a contango, in other words, the nearby futures are lower, all they're doing is rolling. The reason why that it's more is because of the fact that there's carrying charges involved with it, insurance. That's why. So it's really what you're trading is the pattern itself. So when you roll it from June over to August, it's no big deal. Just do it and then just treat it like it's regular gold. There's no difference really.
So if I was to get along the Q contract like last week and hold it until next week, the price would not change? It would revert back to the gold contract price?
No. Stay with it. Stay with us, Dan, and I'll go through that with you. I'll stay with you, and I'll be with you in just a minute. Okay, we're talking with Dan from Miami. Dan, are you still there?
Yep.
Okay, listen, what you've done is you bought June, and what you're going to do, you bought June gold, and you're going to roll it over to August. Now, that's the next liquid contract. After August, it goes to October, and then to December. Each one of those will be a little bit higher because it's a futures contract. And what they do is they have these specifications that there's so much insurance and there's so much storage that cost to hold those contracts. And so that's how that works. I suggest you go to the CME website, www.cme, and they've got a little tutorial they'll walk you through that. But when you're rolling over from June to August, you're still long gold. You're just paying a premium because the futures contract for August, you've got all of July and almost in 3 weeks in August in order to use that. So they charge you those few dollars. So the move that you get will be the same. In other words, it'll be tick for tick versus the cash gold, but you pay a premium because you're in that futures market. You're not in a spot market. Dan, if you want to get away from that, trade the GLD, just the gold. That's the ETF for gold. And that'll give you the same bangs for the bucks, and you won't have to worry about the rollovers or anything like that. Okay?
Well, I think I understand. Yeah. All right. Thank you.
I hope that helps. If you have any other questions, let us know, and I'll see if I can expand further. But go to that CME website. They'll give you a little tutorial on it that'll help a little bit.
Yeah, I will. Thanks.
You bet.